Welcome, everyone. Today, we're doing a deep dive into banking and financial services for 2025. It's always changing, isn't it? And keeping up with what really matters can feel like a full-time job.
It really can. There's just so much noise out there, so many reports, so many predictions. What we want to do today is cut through that. We're drawing heavily on some sharp analysis from Mesh Digital LLC, but also bringing in wider industry data.
Exactly. The goal here is to pull out the core insights, the stuff that actually matters for understanding where things are headed. So our mission, if you like, is to really dissect the big trends, the challenges, and maybe the opportunities in banking and payments for 2025, using that Mesh Digital perspective as a key guidepost.
And we have to set the scene, right? The whole economic backdrop is shifting. Inflation's cooling off, which generally means slower growth and lower interest rates coming down the pike.
Like the European Central Bank looking at maybe 2.75% by the end of 25.
Exactly that kind of move. And that shift, that macroeconomic context, well, it's going to have a massive impact on how banks operate this year.
Okay, so let's jump right into one of the central points that Mesh Digital highlighted, this profitability challenge, especially with rates potentially coming down.
Yeah, this is a big one. The thing is, even if overall interest rates nudge down, deposit costs for banks, particularly in the U.S., might stay relatively high. Sticky, you could say.
So a bit of a squeeze then.
A real squeeze on net interest income. It means banks need to get, well, pretty creative about how they actually make money from interest. It's not just about waiting for rates to magically go back up.
So does that mean lower rates will automatically boost loan demand? Like mortgages should take off?
Well, you'd think so, right. And yes, we probably will see some improvement in the mortgage market. Makes sense. But the analysis, including Mesh Digital's view, suggests it's maybe not quite that simple across the board.
How so?
For things like credit cards, auto loans, consumers are still feeling the pinch financially, so their appetite for more debt might be kind of muted. Plus, if there's still uncertainty about exactly where rates are heading, people might hesitate on big-ticket items.
Okay, that makes sense. And what about businesses borrowing?
That looks more stable. Corporate borrowing should hold up okay. And actually, if some of this uncertainty in the wider world eases off, you might even see a bit of an uptick. More debt issuance, maybe more M&A activity.
Right. And all this while banks are still facing significant running costs. Efficiency must be huge.
Oh, absolutely massive. Some industry data suggests the average efficiency ratio, basically, how much it costs to earn a dollar, could be sitting around 60% this year.
Wow, 60%.
Yeah. So managing expenses isn't just important, it's like a top-tier priority. They'll be looking everywhere to trim costs, but still needing to invest.
Which I guess leads us straight to another key theme from the Mesh Digital analysis. Needing to grow that non-interest income, fees, services, that kind of thing.
Precisely. Because costs keep climbing, salaries, essential tech investments, just general inflation, they have to find revenue elsewhere. For payment companies, for instance, it's about making transactions super smooth, super secure to get more volume.
And adding value on top.
Exactly. Value-added services. That's a big lever.
And we're seeing card companies get more creative with co-branding deals, aren't we? Not just airlines anymore.
Definitely. Think in-app gaming, social commerce platforms. New territory. But fundamentally, it comes back to security and options. Studies show over half of shoppers will ditch a purchase if their preferred payment method isn't there.
Over half. That's huge.
It is. And people are worried about fraud, too. A significant chunk, maybe 25%, feel less safe paying online now than they did, say, 10 years ago.
Okay, what about wealth management? They rely heavily on fees. How are they navigating this? Especially when clients aren't always thrilled about fees.
Yeah, that's a challenge. Client satisfaction with fees isn't great. Data suggests maybe only around a third are really happy.
Right.
So as Mesh Digital points out, they need to double down on showing their value. Better communication, maybe, both in person and digitally. Also expanding what they offer, tax help, estate planning, not just investments. Making the whole experience more personal, fixing problems before they blow up, smooth onboarding. All that relies on good tech, too.
And even in capital markets, they're looking at different fee structures.
It seems so. Some talk suggests looking at less conventional fees, like maybe higher breakup fees if a deal falls through, especially if it's due to regulatory issues. Potentially quite high, maybe even 25% in some scenarios.
25%? Wow.
Yeah, and maybe higher fees just for announcing deals, too. And looking globally, areas like Asia-Pacific with strong wealth growth are obviously big targets for growing that fee income. Mesh Digital's analysis aligns with that view, too.
Let's switch gears a bit. AI. artificial intelligence.
Hmm.
It feels like it's gone from sci-fi to, well, almost mainstream in banking discussions.
It really has. It's not just hype anymore. It's becoming reality. Some projections are pretty staggering, suggesting AI could add trillions to global banking profits by 2028. Maybe a 9% boost over 5 years.
Trillions. Okay, so what does this AI-powered bank, as Mesh Digital puts it, actually look like?
It's about deep integration, machine learning, neural nets, NLP, generative AI woven into everything. But the key focus, and Mesh Digital emphasizes this, is responsible AI. It means rethinking governance, processes, even the kind of people you hire. It's not just about plugging in a new tool.
But isn't old technology, legacy systems, a massive roadblock?
Huge roadblock. That comes up constantly in industry surveys. Something like 60% of banking leaders say legacy tech is holding back growth.
60%.
Yeah. So you see why modernizing is so urgent if they want to leverage AI properly. And we are seeing movement banks planning bigger investments in data management, cloud infrastructure, specifically for generative AI.
We keep coming back to costs. Expense management seems unavoidable.
It really is. For the bigger banks especially, non-interest expenses have been growing faster than revenues. And that trend looks set to continue. We saw major banks increasing their expense forecasts last year.
What's driving that mainly? Still people and tech.
Primarily, yes. Compensation costs, the constant need for regulatory compliance work, and these huge, necessary tech investments we've been talking about, they all add up.
Okay, let's zoom out again. What about globally? Europe, Asia? Are they seeing the same things in 2025?
Similar trends, but with regional twists. Europe and Asia also expect rate cuts, but probably slower economic growth alongside them. That could be a tougher environment.
Especially for European banks, perhaps, if rates stay low.
Potentially, yes. The analysis suggests European banks might find it harder to maintain profitability in a sustained low-rate world compared to, say, U.S. banks. Though, on the flip side, European investment banks seem keen to challenge U.S. dominance in deal-making more forcefully.
In emerging markets,
Yeah.
Asia Pacific.
Generally, a stronger outlook there, aligning with Mesh Digital's view, especially in high-growth economies. But the big question mark is the timing and depth of rate cuts. That'll be a real test.
Interesting. And we're also seeing the Middle East becoming more attractive for wealth.
Very much so. High net worth individuals, families, drawn by quality of life, stability, good financial infrastructure, attractive tax setups like the UAE's Golden Visa, for example.
Which creates its own challenges, I suppose, like finding talent.
Exactly. There's a real shortage of experienced relationship managers for private banking emerging in both Asia and the Middle East because of this influx.
Right. Now, payments. Always a hotbed of activity. What's the story there for 2025?
Well, fraud is still a massive headache. Recent reports from some areas, like the UK, showed a big jump in cases in the first half of 24. Even if some types of fraud losses are down, losses on business accounts hit record highs.
Ouch. What else?
Digital wallets keep growing, especially in e-commerce across Europe. And this year, 2025, is huge for Europe, with the instant payments mandate really kicking in. Deadlines in January and October mean banks have to be ready.
Instant payments. That feels like a fundamental shift.
It is, and AI is going to be crucial for developing and pricing payment products around this. Also seeing more focus on multi-generational households as a distinct customer group for payments.
And new players face challenges too, like neobanks.
Yeah, they seem to be particular targets for certain types of payment fraud. On the security front, expect more use of passkeys for authentication. It's supposed to be more secure.
But people still like email for documents.
Surprisingly, yes. Data suggests around 65% still prefer email for financial docs. And believe it or not, paper checks are still around, and so is check fraud.
Some things never change, and the tech behind payments gets more complex.
Definitely. That's why the market for reconciliation software making sure all the numbers add up is growing fast. Cross-border payments are getting better, faster. And we might be nearing a tipping point for stablecoins being used more, but banks need the right infrastructure for that.
And pay by bank.
Also growing, direct payments from bank accounts are gaining traction.
So much tech driving all this. What are the absolute must-do tech priorities for banks now?
Number one, still dealing with those legacy systems. They just block everything else. Cybersecurity is obviously huge and getting more complex. Maybe we'll see more use of things like homomorphic encryption or federated learning for data security.
Fancy terms.
Yeah, but basically clever ways to protect data. And you absolutely need a solid data foundation to make AI work properly. With instant payments becoming standard, managing the associated fraud risk is critical.
So banks need to fix the basics, but also innovate.
Exactly. Get the digital basics right, but also invest in things that make them stand out, or they'll lose customers. Open banking is becoming really important here, too, for enabling faster, more secure payments.
And regulators are watching all this tech closely.
Very closely. Expect more scrutiny on anti-fraud and anti-money laundering measures, especially in newer models like banking as a service or embedded finance.
What else on the tech front? Wearables?
Oh.
Cloud?
Yeah, maybe more wearable tech for payments, core banking systems continuing their move to the cloud, open banking expanding further, driving personalization, data governance broadening to cover AI, more AI, and maybe distributed ledger tech deployed, APIs becoming crucial for modernizing payments and treasury. And underlying it all, data quality. Need good data for fraud detection, for regulation.
Okay, let's talk regulation specifically. What are the big things on the radar?
Well, the Basel III endgame rules got reproposed, maybe suggesting slightly lower capital needs for banks, but that's not final yet. We could see banks holding less excess capital, which might fuel more M&A, especially among smaller banks, say under $250 billion in assets.
In consumer protection, payments regulation.
Definitely tightening. More focus expected there, like PSD3 coming in Europe. There's also the PCI DSS 4.0 security standard deadline, March 31st, 2025. That's coming up fast. Right, the Digital Operational Resilience Act in the EU. Big implications for managing tech risks and reporting incidents. Plus, a new EU anti-money laundering authority starts work mid-year, likely meaning stricter rules, especially around digital assets.
Anything else? Finfluencers, regional efforts.
Yeah, potentially more regulatory eyeballs on social media influencers. And we're seeing efforts to harmonize regulations within regions like ASEAN.
Finally, let's bring it back to the customer. How are their behaviors and expectations changing things?
Well, the fight for deposits is intense. Neobanks, fintechs offering higher rates are putting pressure on traditional banks, though banks with really good mobile apps are seeing big gains in new accounts.
The personalization is key.
Absolutely non-negotiable now. It's an expectation. Also, consumers are thriftier, hunting for deals, so discount retailers are doing well. And as we said, many still prefer email for docs.
Security is a bigger factor, too.
Huge factor in choosing payment methods. We're also seeing more interest in tailored banking for multi-generational households. People seem more aware of pension savings, too, so likely more demand for financial advice.
And insurance.
More focus on ethics, transparency, and wanting seamless, embedded insurance options, buying insurance as part of another purchase, basically.
So wrapping this deep dive up, it feels like a few major themes keep intersecting.
Definitely. You've got the profitability puzzle in a low-rate world. You've got the absolute need for digital transformation, heavily driven by AI. The payments world is constantly shifting. Regulators are more active than ever, and customer expectations just keep rising.
It's a complex picture, but hopefully this discussion, drawing on Mesh Digital's analysis and other industry insights, gives a clearer view of the forces shaping 2025. It's definitely not static. These trends will keep interacting.
Which leads to maybe a final thought for listeners. Thinking about all these trends, AI, regulation, payments, customer shifts, which one, or maybe which combination, do you think will most profoundly impact your financial life or your work in the year ahead?
That's a great question to ponder, something to definitely think about as we navigate the rest of 2025.
Indeed.
Thank you for joining us for this deep dive. We hope it's been insightful. Do keep exploring these topics, and we'll be back with more analysis soon.